You want to invest, but you have no idea where to start. Sound familiar? Today, we're going to explain one of the most beginner-friendly investment tools in the world, the ETF. And we'll start with pizza. Imagine you order a pizza with just one topping, only pepperoni. That's like buying a single company's stock. All your money rides on one ingredient. But what if you ordered the everything pizza? Cheese, mushrooms, olives, meat, peppers, all at once. That's an ETF. One slice, dozens of ingredients inside. ETF stands for Exchange Traded Fund. It's a basket of securities, stocks, bonds, or other assets that trades on the stock exchange just like a regular share. One of the most popular ETFs, SPY, tracks the S&P 500 index and holds shares of the 500 largest companies in the United States. Apple, Microsoft, Amazon, Tesla, Nvidia, all in one. By buying just one share of that ETF, you instantly become a part owner of all 500 of those companies at once. Here's how it works in practice. A fund management company creates the ETF, buys a basket of assets inside it, and lists the whole thing on a stock exchange as a single tradable share. You open a brokerage account, buy one share of the ETF just like you'd buy any stock. And when the companies inside the fund grow, so does the value of your share. So what makes ETFs so popular with beginners? First, instant diversification. One purchase, and your money is spread across dozens or hundreds of companies. Second, low fees. ETFs typically charge between 0.03% and 0.5% per year. Compare that to actively managed funds that can charge 1% to 2% and eat into your returns significantly. Third, simplicity. You don't need to research individual companies, read earnings reports, or pick winners. The index does the work, and you can start with as little as $1 to $10 on many platforms. But ETFs aren't perfect. They won't protect you from a broad market crash. If the whole market falls, your ETF falls too. You can't beat the index with an ETF. You can only match it. And there's always risk of loss. ETFs come in many varieties. Index ETFs track a broad market index, like the S&P 500 or the NASDAQ. These are the most popular among long-term beginners. Sector ETFs focus on a single industry: technology, healthcare, energy. Bond ETFs hold fixed income securities and are generally less volatile, good for stability. Commodity ETFs hold gold, oil, silver. And dividend ETFs focus on companies that pay regular dividends. For most beginners, the simplest starting point is a broad index ETF, like VOO, IVV, or SPY. These three track the S&P 500 and are among the most widely held investment products on the planet. Let's compare. You have $500. Option A. You buy shares of a single company. It drops 40%. You lose $200. That's painful. And it happens more often than people expect. Option B. You buy an ETF of 500 companies. One of them goes bankrupt. Your total loss? Less than 0.2%. The other 499 companies keep working, and your portfolio barely moves. Ready to start? Step 1. Open a brokerage account with a reliable broker. Fidelity, Charles Schwab, or Interactive Brokers are popular options in the US. Step 2. Define your goal. Long-term growth? Dividend income? Capital preservation? Your goal determines which ETF type suits you best. Step 3. Choose your ETF. Step 4. Invest regularly, even small amounts every month. Consistency over time is what actually builds wealth. The amount matters far less than the habit. Let's wrap up. An ETF is a basket of securities that trades like a stock. Low fees, instant diversification, no need to pick individual companies. Available from as little as $1. And it's one of the best tools a beginner investor has. Think of it like the everything pizza. One slice and you've got the whole menu covered. If this helped you, hit like, subscribe, and drop your question about ETFs in the comments. See you next time!